Welcome to a deep dive into Chapter 2 of the Life and Health License Exam Manual. I'm Felicia, and over the next 10 minutes, we are going to master the regulatory framework and essential definitions that form the backbone of the insurance industry. This chapter is critical for your exam and your professional career, so let's get focused and started. In this lesson, we'll explore the balance between state and federal authority, the powers of the insurance commissioner, and the ethical standards known as unfair trade practices. We'll also break down the National Association of Insurance Commissioners and privacy laws like the Gramm-Leach-Bliley Act. Our goal is to understand not just the what, but the practical why behind these rules. Let's start with some foundational definitions. First up, what are pretext interviews? Pretext interviews are generally not permitted in insurance transactions unless some evidence of criminal activity exists. A pretext interview is one where the interviewer pretends to be someone else, misrepresents the purpose of the interview, or refuses to identify themselves to obtain information. It's a protection for the applicant's privacy. Next question, how do we define a customer? A customer is anyone with whom the company has an ongoing relationship. This is distinct from a consumer who might just be looking for a quote. In insurance, those relationships involve active policies and continuous interaction, and these customers are entitled to specific annual privacy notices under federal law. What is the federal government's role in all of this? The federal government has the right to regulate the business of insurance, but only to the extent that such business is not regulated by the state. This principle ensures that regulation remains primarily at the state level, where local market needs are best understood and managed. So who writes these rules? Insurance laws are generally written by the state legislature. These laws establish the code that all companies and producers must follow. The enforcement of these laws, however, falls to a specific individual, the head of the State Department of Insurance, usually called the commissioner. The commissioner is responsible for administering and enforcing state insurance law, imposing penalties for violations, and issuing insurance licenses. However, there's a key distinction. The commissioner is not responsible for reviewing every single policy before it is issued. They approve policy forms in general, but the day-to-day issuance is handled by the companies themselves. The non-financial regulatory activities of an insurance department fall under the broad heading of market conduct. While solvency regulation focuses on the company's bank account, market conduct focuses on how they treat people. This includes auditing their sales practices, underwriting, and how fairly they handle claims. It's about ensuring the market remains honest and fair for everyone, which individuals would not be exempt from a producer licensing requirement. Anyone working in an insurance office conferring directly with or offering advice to prospective purchasers about benefits, terms, and conditions of insurance policies is not exempt. If you are urging a person to apply for a policy, you need a license. Conversely, staff assisting on non-sales related areas or people who inspect and classify risks are generally exempt. What about temporary licenses? These are granted in specific circumstances, such as when a producer passes away or becomes disabled, to allow someone to continue the business. However, a person who simply wants to try out selling insurance before investing in education will not be granted a temporary license. They are meant for continuity, not for testing the waters. If a licensed producer moves to a new state, how long do they have to become a resident licensee? A person licensed in another state who moves has 90 days after establishing legal residence to become a resident licensee without taking the pre-licensing education or exams, provided they were in good standing in their previous home state. Producers may act in two distinct roles. As agents, they legally represent the insurance company, and their acts are considered the company's acts. As brokers, they represent the individual customer, shopping the entire market to find the best policy for that specific person. Understanding who you represent is fundamental to your legal and ethical duties. Why is insurance state regulated instead of federally regulated? This was defined by the McCarran-Ferguson Act of 1945. It states that the federal government will only step in if the state fails to regulate the business properly. This landmark act solidified the state-based system we use today. Associations organized to protect claimants, policyholders, and creditors of financially impaired insurers are known as guarantee associations. If a company goes bankrupt, these associations step in to pay claims and continue coverage up to certain limits. It is a safety net, but remember, it is illegal to use the existence of this fund as a selling point to customers. Business written on the producer's own life or interest is called controlled business. States monitor this closely. A license cannot be used primarily to save money on your own insurance. You must be actively serving the general public to maintain your status as a professional producer. Now for unfair trade practices. Misrepresentation involves making false or misleading statements about a policy's benefits. Defamation is making false or malicious statements about the financial condition of an insurer to harm them. And twisting, that's a big one, is inducing someone to drop a policy based on a misleading comparison. Each of these carries heavy penalties. We also have rebating, which is offering something of value to a customer that isn't in the contract to induce a sale. Boycott, coercion, and intimidation involve using threats to restrict fair trade or create a monopoly. Finally, false financial statements involve lying about an insurer's solvency. All of these undermine the trust that the insurance industry depends on. Finally, let's talk about the National Association of Insurance Commissioners, or NAIC. This organization establishes model laws that states often adopt with slight changes. They promote uniformity and support state regulators, though they don't have the power to make law themselves. They are a vital resource for staying current in this ever-changing field. We've covered a lot today, from the role of the commissioner to the ethics of market conduct. Remember, these rules exist to protect you, your company, and most importantly, your customers. Review these definitions often as you prepare for your exam. Mastering the why will make the how much easier. Thank you for joining me for Chapter 2. Stay dedicated to your studies, keep your ethics high, and you'll do great. I'm Felicia. Keep at it and good luck out there.